All right, let's get this started. It's time for a Patreon exclusive episode. It's been a while. I actually think I'm a little bit behind on this. So we have some questions to go through, some comments. This is the Ask Me Anything channel. It's just a place where if you're new here, you can just type in your thoughts on a subject, something you want to bounce ideas off of, and I'll give you the best take that I have on it. None of it is pre-rehearsed. I haven't looked through these yet. So it's just off the top of my head. None of it is personalized investment advice. So we're going to be going through some Ask Me Anything. I'll be answering your questions. And before we jump into that, I just wanted to give a quick update on things that are going on. First of all, an update for you guys. The Discord community, the Patreon community, the members here, I continue to be really impressed with especially the progress over the past couple of years. One thing I notice is that people are investing aggressively, buying really, really good companies. The level and quality of research done on the Discord has gone up dramatically. I look at all the different stock discussion channels, and it's on the fundamentals of companies, their financials, their business, their growth prospects, on really what drives a business over time. I'm seeing that across really high quality companies. I don't see a lot of speculation. I don't see a lot of people dumpster diving into a bunch of junk companies trying to time the bottom of them. I don't see people trying to go for quick gains, all these type of gimmicks that different investors do that they lose money. I see real fundamental investing being done here, and it's pretty cool to see. And the members here, I will say, so much progress with portfolio growth. One thing that I've noticed in this community is when people join the community, sometimes they come in, they have like 15 grand that they're investing, right? Just some savings that they have. And then like 2 years later, they're like, hey, I hit 100,000 and invested. I'm in the 100,000 club. I'm like, you were at 15,000 2 years ago. How'd you get $100,000 invested? And they're like, oh, well, I just got real excited. I watched the content. I've been investing every paycheck, all this money, building this up. So most of it comes from, at the beginning, it's largely from deposits, putting money in. But that is incredible. And to get to that point where you want to put that much money that you've worked for into the stock market, there needs to be some excitement behind it. There needs to be, even people do better in investing if they're excited about it, if they're motivated to put money in. And I've seen a lot of that over the past couple of years. People's portfolios growing like crazy. Then, of course, when you get up a little bit, you get to the point where you have 100,000, 200,000, then the gains in the portfolio make a significant difference. So even though I put in $50,000 in 2024 into my portfolio made like 250 grand, right? It made a lot of money combined, way past what I put in it because of portfolio size and the compounding. So I'm seeing progress in the net worth clubs, people moving up. Overall, I see better moderation. We've increased the moderation on the Discord. I think I've done a much better job in that because I see less bickering, less arguing, less personal insults, fewer instances of that going on, and way more discussion about stocks and things that move the needle forward. So overall, I'm very happy with the progress of the community here and the Discord. In terms of Patreon, the membership here, it's now at 8,000, roughly 8,300, so around 8,300 members. It's grown to record highs. Just yesterday, it hit a record high. The month, it's gained a ton of new people, so welcome if you're new here. I hope you enjoy it and get a lot of value out of it. I think the value here is really good. What we're doing with Qualtrim and for the price point, I think is obviously earning a lot of people's trust. So with Qualtrim, I'm meeting with my developer. We're implementing so many different improvements, bug fixes, feature revamps, and new features. We're going to have a new homepage, so to speak. When you haven't searched a stock, what's displayed underneath right now is just your recent searches and the top movers. It's going to be way better. That page right there it's not going to be a stock filter, but it's going to be more browsability. You're going to be able to look through stocks and get different ideas on different verticals of stocks. So we're going to implement that soon. And we have so much more going on. There's so many cool things we're doing with Qualtrim. In terms of the YouTube channels, the viewership is crazy. We're getting 50, 70,000 views in a single 24-hour period. A lot of the videos are getting well above 100,000 views, 200,000 views. The one on ASML is over 200,000 views. It's like a 50-minute video. That's difficult to get an hour-long video, 200,000 views on YouTube. That's a difficult thing. I've been doing YouTube for a long time. To get 200,000 people to go, yeah, I want to watch an hour-long video on this niche stock that Joseph is buying, that is this maker of this complex machine. Like, that really is something else. And I think it's cool because ASML is an incredible company. It's actually fascinating in and of itself. And so it's fun to be able to at least get it out there and get more people aware of these great stocks that exist. I think that that's a fun thing to do. But the numbers on the YouTube are crazy. The numbers on the Patreon are the Discord community, the engagement, even on Qualtrim, the amount of people using all the different features I track, and it's all been pretty incredible. Now, again, I want to get into the Ask Me Anything. Before I do that, I just have to jump into TSM. TSM had their earnings report, and if we look at it, let's go ahead and bring it up here, in fact. Let's take a look at TSM. Now, why is TSM important? They're one of the companies that kind of brings it all together, right? They use all these different manufacturing, and they kind of bring the whole assembly line together. So they're the ones that make mostly high-end chips. So if you have really dumb chips, like ones that display the time on a microwave, right? If it's just like a clock, TSM isn't like making an advanced chip to display a clock, right? But for an iPhone, or one for a Tesla, or they're making the ones that NVIDIA designs, right? NVIDIA is a designer. They're not the manufacturer. TSM is the one that puts that together. They take the designs and put it together. So they're important because they play that last role in the pipeline of it. Now, TSM is up 5.16%. The quick summary is the shares are trading higher after the company reported better than expected Q4 earnings per share and revenue, and issued Q1 guidance above the estimates. Now, I feel good about this for a couple reasons. One reason why is I like my predictions being correct. If you recall my episode yesterday, I said that it's difficult to guess. I always give that disclaimer, but I think the report's going to be good. When I look at what happened in 2024 and the amount of money flowing into data centers and that type of thing and high-end chips, I mean, come on, it's got to be pretty strong. So I'm very happy about this because it sets the tone for that entire industry. For example, you can look at ASML, and ASML's, I think it's up even more than TSM. ASML is beaten down a little bit because investors are concerned about it, right? They're always trading around the demand. Now that TSM's reported and said, hey, things are great, we're getting lots of demand, things are going well, ASML is up. Applied Materials, haven't even looked at it yet, but I know it's going to be in the green. They play a role in the TSM processing. So it's basically like, it's interesting. It's like TSM is like Amazon, and Applied Materials is like the ad business, and ASML is like AWS, right? They play this role as part of the bigger company, but a little bit more broadly. And I love seeing all these companies doing well. So we're off to a great start. One thing I could do, in fact, let me do this. Let me go to the transcripts page here, and let's see if the report's up. Here we have it. There we go. TSM January 16th, that's it. We have the report in. What Qualtrim does here is we have two different things we can look at. We have the full transcript. This shows you it in like bubble format. You can filter by specific people, by the CEO or whatever, and read through the entire thing. Now, the entire thing is probably 20 pages long, maybe even like 30 pages long, right? It's an hour long of conversation. So let's just take a look at the summary. This is the AI summary that Qualtrim makes. I broke it down by different segments of the typical earnings report. During TSM's fourth quarter of 2024 earnings call, the company reported significant growth in revenue, largely driven by advanced technology adoption, 3 nanometer and 5 nanometer process technologies. The company anticipates continued strong demand, particularly in AI and HPC, setting a positive growth trajectory in 2025. Now, the summary of the CEO's comments is the Dr. C.C. Wei noted the mixed recovery in 2024 with AI-related demand being a significant driver. He expressed confidence in TSMC's leadership and capability to meet increased demand from industry megatrends, emphasizing plans for expanding global manufacturing. That's good for ASML. Expand across the globe, TSM. Buy more machines from ASML. Go ahead and do it. You're making money. Go ahead and buy more ASML machines, especially in response to customer needs and government support. Financial performance. This is basically the CFO's comments. In Q4 2024, TSMC experienced 14.3% revenue increase sequentially. So that's quarter over quarter. Gross margins rose 59% due to higher capacity utilization, while operating expenses, were kept at 10% of net revenue, resulting in a 49% operating margin. So that is operating leverage. They're keeping their expenses low, a low percentage of their overall revenue. They have huge operating margins. The company posted EPS of 14.45, ROE of 36.2. The business highlights: advanced technology, primarily the 7nm and below, drove much of the revenue, constituting 74% of the wafer revenue. HPC showed a notable 19% increase, making it 53% of total revenue. Expansion plans in regions like the US, Japan, and Europe are underway to support future growth. I love it. I love seeing TSM expand across the world because in every facility that they build, manufacturing facility, they're going to have an ASML machine. I'm invested in ASML, so that means more business for my investment, more maintenance business, more distribution of what they're doing. It's overall good for the entire chain, but especially the company I'm invested in, ASML. In terms of future outlook, TSMC expects the first quarter of 2025 to see sequential revenue decline due to smartphone seasonality. That was expected, but projects a strong year-over-year increase. It maintains a long-term revenue growth forecast approaching 20% CAGR, supported by advanced AI, HPC, Internet of Things, and automotive sectors. Lots of diverse revenue parts. I don't think it's just AI driving this. If you look at these companies, a lot of people say, oh, it's just AI driving this. And once the AI thing kind of settles down a little bit, these companies aren't going to do well. It's not just AI. Look at ASML. Let's just take a look here. We go to ASML. We know that TSM is expanding across the globe in Japan and all these other places in the US, right? So that's a great thing. But look at the revenue of ASML. Right here is like 2012, right there. You have revenue of $5 billion, and then up to 2020, you have revenue of $20 billion. So they 400% grew 4x their revenue in those 17 years. Now, was there AI here? No, there wasn't AI there. LLMs didn't exist then. There wasn't any open AI. There was no models for AI. This growth happened just by growth in technology, just by more smart devices. Think about it. I have a fridge that has you can tap on it and do all these different things. It obviously has a chip inside of the fridge to manage all the various degrees of everything. It has different lighting systems. That came with a chip that's probably designed by ASML. Don't know for sure, but a lot of microwaves and refrigerators are becoming smart devices. They have tablets built in. So the growth in these companies is not just driven by AI. AI is just another factor layered upon the organic growth, spurring it a little bit faster. But the combination of AI with its already baseline of organic growth just by technology growing, I think is going to be good. I think it's going to be good over the next 10 years. I can't predict year by year what it's going to be, but I just can't imagine this company being anything but much bigger in the next 10 years. So overall, very happy with TSMC. I'm happy with the big banks reports that the US economy is strong. I'm feeling more bullish about this quarter. I think we're going to see good things. I could be disappointed. I'm setting myself up for disappointment, but I just feel good about the companies I'm invested in. I think they're going to come out with strong reports. They have to with the valuations that they have, but we'll see. Let's go ahead and move on to some questions here and see what's on your guys' minds. Hi, Joseph. What are your thoughts on crypto as an alternative allocation in one's portfolio? especially Bitcoin as it's being observed as a store of value with fixed supply similar to gold. Historically, if one allocates a 1 to 5% allocation to Bitcoin, the returns were pretty strong over the long term. Okay. I like the question, and I keep an open mind about everything. Every opinion I have on every subject, I'm willing to change based on an argument that convinces me I'm wrong, or based on new information, based on me figuring out I got something wrong in the past, right? So I keep an open mind, and I'm not set in stone on anything. Now, having said that, my current opinion is that I think it's fine to own a little bit of Bitcoin in your portfolio. Like, I don't think it's going to hurt anything. The problem I have, I think, with Bitcoin in particular, is at least from my perspective, I feel like most people that invest in it, the only reason they invest in it is because they think they're going to get a good return based on the historical performance. Like, basically, they just looked at the chart going back 10 years and they're going, wow, Bitcoin's gone up a lot. I want to be a part of that, and I want to ride along and have it go up further. And that's the literal definition of FOMO, the fear of missing out. You don't want to miss out on the future returns of Bitcoin, so you buy in. And you pay $100,000 for one of something that, in my opinion, only really has value because other people are just buying in. Stocks don't just have value because other people are buying in. Stocks have value because they generate cash. That's why they have value. If a stock didn't generate any cash throughout its entire lifetime, like if a company generates no profits its whole lifetime, it doesn't matter how many investors buy in and buy out. That thing never had intrinsic value. Another way of saying this is, even if nobody bought a stock, even if the company was just privately owned, as long as it generates cash flow, it has value. The Joseph Carlson show is privately owned. There's no investors buying and selling it. The thing has value because it generates cash flow for me. So the problem I have with Bitcoin is the value is dependent on other people buying in and out. Most people I believe that are invested in Bitcoin aren't investing in it because of the use cases. They don't really believe it's going to be used in daily transactions. I don't think they really view it as a store of value. You can store value in all different 10-year treasury you can store value in. I think they might consider it like a hedge against inflation, but in my opinion, there's better inflation hedges. I just don't believe that the real reason all these people are buying Bitcoin is because of the practical uses of it. I think they're buying it because they want to be a part of a momentum trade where things are going to continue to go up. And to me, I don't want to be a part of a momentum trade. I want to buy things because they're going to pay me back in cash over a long period of time, and I'll get returns that way, irregardless of whether or not other people buy in. So that's how I view it. It's not by the way, Bitcoin is just the popular one. My view is the same on any non-productive asset, and a difference between a productive asset and one that's non-productive in the way that I'm using it is a productive asset just means that it generates cash in and of itself. So I don't invest in gold. I don't invest in, my dad buys signs. He buys like old Coca-Cola and Disney signs and oil signs, and his whole garage is just plastered with them. And they're worth a lot and they go up in value over time. But I don't invest in those either because they're not productive. They just sit there and hopefully someone pays more for them in the future. I don't think it's bad. I like his sign collection. I think it's a cool thing. But right now I'm focused on buying things where the cash flow is going to be so much higher in the future. I'd much rather put my money and buy something like MasterCard where I can look at the free cash flow. Look at this thing. If I buy it here in 2017 and it's generating $4 billion in a year in free cash flow, and then I hold it till 2024, it's generating $14 billion, an extra $10 billion that they can return back to the investor. They can give it right back to the investor, and that's what they do. In 2014, they're returning $3 to $4 billion through dividends and buybacks. Now they're returning next to $12 billion, mostly through, they repurchased $9.4 billion. That increases my ownership, and they're paying $2.38 billion in dividends. So I like things that pay me back. That's production. That's a productive asset. That's what I'm focused on. Hi, Joseph. Thanks for all you do. I found your recent video very good. My question is, if you had $100K, 40% invested and the rest in cash, Considering the market valuation and what I want to grow my wealth in a stable and consistent manner, how would you approach this? Like you, my goal is financial independence and eventually living off of dividends. Yeah, if I was 40% cash, for me, that would be like $400,000 in cash. You can focus on what you know. Okay, let's think about, like, a lot of people focus on what they don't know investing, all the unknowns. Let's focus on a couple things we do know. What is the max value you can get out of cash? Like 4% per year. And then what is inflation? Like 3.5%. True inflation, 4%. Look at the prices of things going up over time. The cost of food, the cost of vacationing, the cost of buying a house. This stuff goes up like crazy. I think when you have so much money in cash, that cash is just being eroded by inflation. I'd rather put my money in companies that at the very minimum are going to be a hedge against inflation. So what type of companies are hedge against inflation? They're companies that earn more money as a baseline when things become more expensive. For example, Costco, if everything in your life, like all the stuff that you shopped for became 50% more expensive, not a problem for Costco. They'll just sell stuff for 50% more. The revenue will go up 50% more. The vacuums they sell are going to be 50% more. The food they sell is going to be 50% more. All the inflation's passed right along to the consumer. Costco is an inflation hedge. The same thing with MasterCard. If inflation happens in the economy, they take a cut of it. So their revenue will naturally grow. I like those type of companies, and most of them in my portfolio are huge inflation hedges. So that's at a very minimum. But if you're looking at like what's the best buy right now, your question can be taken a few different ways. I think Google's a good buy. I think ASML's a good buy. I think Booking is attractive right now. There's a lot of companies that I think are interesting. And if you can't figure out any to buy, my recommendation is just to throw some money into broadly based ETFs like the S&P 500 or like a growth ETF, and do that as much as you can over as long a period as you can. Not time it. The market goes down, right? If the market drops 50% right after you put all your money in, don't fret. Just try to put more money in, right? Don't time it. If you have 20 to 30 years to invest, you're going to be fine. So that's my thoughts. It's just overall, I would not want to sit too long with 40% cash. It's my opinion. I'm not Warren Buffett. I don't run Berkshire Hathaway, a massive company. I don't have millions of investors relying on me. I don't own insurance companies that might have massive payouts that they have to give because of disaster. So I don't compare myself to Buffett and having 30% cash. Hi, Joseph. What are your thoughts on SoFi? I like it. This is one, every time I look at the numbers, I love the KPIs. We threw in some KPIs in Qualtrim. Look at this revenue growth on a trailing basis. Look at this membership growth. It's fantastic. Look at the products and services growth, financial service products. These are great. Yeah, I really like it. I think it's a decent company. Anybody that invests in SoFi, I don't have any problem with it. My only argument is like a lot of people try to pretend like it's something it's not. They're like, it's a revolutionary company that's changing the game from the ground up. I mean, it's a bank that has a technology edge. It's a service style bank. Still good, but let's call a spade a spade. What are your thoughts on Rivian Automotive? Like any auto company, I'm probably not going to be buying the stock, but I do really like what they're coming out with. I think their vehicles are really impressive. I don't know whether I like the aesthetic, or I guess I don't love the aesthetic, but I don't hate it. It's somewhere in between. I think they're unique looking. So it's kind of one of those companies I don't have any problems with. I think they're doing a good job. I like their partnership with Amazon. The little Amazon delivery vans are pretty cool. Are there any non-public companies that you would love to invest in if they IPO'd? Are they good companies? Databricks, Chick-fil-A come to mind. Curious if we got any. I probably wouldn't buy Chick-fil-A because I just have a feeling that the valuation would be unbelievable. I think it would just be unbelievable if Chick-fil-A IPO'd. And, they run a good business, but I can't imagine what you'd have to pay to buy Chick-fil-A stock. like what would it be? Like a 60 PE ratio right off the bat? I mean, there wouldn't be any. I just have a feeling that one's so well known, so well understood, and there'd be so much buzz about it that everybody would want to jump on that train. Now, a company that I'd love to buy if they IPO'd, that's way different than most companies I buy, and it would be more just because I want to support the company. It would be fun to be a part of it as well. Would be Anduril. So it's a company started by what is his name? Yeah, Palmer Luckey, which is a great name. What a great name for a billionaire. Palmer Luckey started this company. He's the one that started Oculus. So he sold Oculus to Facebook. Then a bunch of drama happened. He supported Trump. Facebook fired him. And now he started Anduril, and he's like, haha, I'm successful anyways. I can do this twice, right? Which is pretty incredible. So the guy knows how to attract capital, start a great company. But the stuff that Anduril's coming out with is advanced warfare devices through drones. And I think it's going to be critical in the national defense of the West, frankly. I think that China is going to come out with this stuff. I think that Russia is going to come out with it. It's clear, even in the war with Ukraine and Russia, that drones are playing a pivotal role. You're able to basically send out drones and, defend yourself and execute different warfare initiatives while risking less human lives. Fewer humans are dying because the drones are killing each other, which I consider a win. I'd rather have a drone die than send over some kid. So I like the idea of using national defense as autonomous vehicles. Drones, and these are ones that the U.S. Army has already had the big airplane drones that can go and bomb things without a pilot. That's old news. But these are little helicopter type of things that can fly around and do on the ground drone activity. They can follow different vehicles. They can do they can look out and see different things. They're incredible, and obviously. There's a dicey moral ground of what they could be used for, but I'm pro-American. I want us to be able to defend our country against adversarial forces, and I feel like Anduril is pivotal because I think that drones are going to be I think they're just going to be the most important thing over the next 20 years in national defense. There's obviously going to be sophisticated warfare. There's going to be things going on in space, but I feel like most of what we do with national defense is going to be drones. I think even in terms of preventing terrorist attacks, I think it's going to be drones. Imagine what a terrorist could do with a drone if there's a big ball game, right? If there's an NFL game and that someone flies in with a drone as a terrorist attack, you're going to need tools to be anti-drone, to clear things out of the air. Anduril is designing and creating that. So they have a huge market opportunity, both for national defense and just for domestic terrorism, and just like they put blockades and stuff at big sporting events, and just like they check for people having bombs or guns and stuff before they walk in with metal detectors, you're going to need to protect the airways, and Anduril can help with that. So that's a company I find very interesting. I love the product development. They're creating an entire OS system to control all these various devices that all of it operates under, and they're doing it in a way that's cheaper for the U.S. government. So unlike Lockheed Martin, the way that they bill it is actually different. They don't just take a bunch of money and then build the product afterwards. They're developing the product, and then they sign agreements with the U.S. government after they've already built the product. And it's much less expensive, and it's a better incentivization structure for Anduril and for the U.S. government than the way that we have been doing things. So that's a company I'd be very interested in to get a stake in, but it's been private so far. One of the issues with the U.S. markets right now is companies have so much capital available to them, which is a great thing for the U.S. There's so many people writing checks privately that companies can stay private for a long period of time. But I think they should go public. Going public is great. Look how many great public companies there are. It does not hurt a company to go public, in my opinion. What do you think of NVO? The charts show positive, and it seems to be in a dip. Don't know enough about that one. Apologies. Could you give an update about your perspective regarding the caffeine bubble video you did 1 year ago? Since the video, Monster is down 15%, Celsius 50%, Pepsi 12%, and Coca-Cola 3%. Yeah, I think it was a correct call. I mean, like you point out, just look at most companies. Most companies that sell caffeinated beverages, they didn't do well. I'll also include Starbucks. Starbucks has a 2% return in the past trailing year, while the S&P 500 is up 22%. So I think this is overwhelmingly, I don't want to pat myself on the back too much. Well, maybe I will, but I just think it was a correct call. I made a video on it. I thought that the thesis was pretty sound, that there's way too much money going into caffeinated beverages. The market isn't growing as fast as many new competitors are putting money into it. There's too much enthusiasm on these companies. The valuations were too high, and they're all competing for the same dollar. Like something had to give. And it turns out all of the companies gave a little bit. Some of them more than others. Celsius has been a disaster. Now, in terms of where it stands right now, that call doesn't last forever. I would say that I'm mostly I'd have to go look at all the companies and the valuations, but I wouldn't make that call today. I wouldn't come out and say there's a big caffeine bubble today. And the reason why is because these companies are now being priced with the knowledge of this increase of demand. A lot of the things that I warned about are finally priced into these stocks. They've been mute, flat, down, in some cases down a lot over the past year. So yeah, some of them having just a barely positive return. Like Coca-Cola's up a slight amount, but most of them are down. I don't, I think it was a correct call, but I wouldn't make that same call today. Hey, Joseph, over your lifetime of investing, what are some of the worst investment decisions? What went wrong exactly? What did you learn from those mistakes that you applied to your investment philosophy moving forward? And overall, just how costly were each mistake? Also, out of the semiconductor companies you could have bought, why ASML over others like NVIDIA, TSM, Broadcom? Is it purely because of valuation risk? If so, could you explain what specific risk you see regarding valuation in these alternative choices? How did you invest in them at the current price? Okay, so I'll start off with your first question. What were some of the worst investment decisions? What went wrong exactly? Well, in terms of there's different types of ways of looking at investment decisions and judging them retroactively, but I'll bucket them into two types of mistakes. One of them is simply just losing money, permanent capital impairment, losing money on a stock. And I've tried to avoid doing that from these mistakes. Disney was a company I lost money on, and I shouldn't have. I was in the green big time at one point on Disney. I held on to the company, and then just everything caved in with Disney. I mean, the leadership was a total mess. What did I learn from that? It wasn't that when I look back on Disney, it wasn't that I should have timed things better and I should have sold at the top. The problem with Disney is that I didn't have great fundamental analysis on the stock. I bought a company that is very complex, operationally complex. It has multiple aspects to the business. That has a blockbuster movie business, that operates parks, that's trying to build a streaming service. They have all these different things they're trying to balance. And I bought it at a time period where there's a lot of excitement. I bought it at a time period where they're transitioning ownership. The valuation wasn't, it was okay when I bought it, but I feel like the big mistake I made with Disney was in my analysis, I was focusing so much on the future of the company and the growth of their streaming service, and I paid very little attention to the decline in their cable TV business. So I wasn't looking at how bad things really were with cable TV and how profitable that was. So Disney was basically a story of growing hair and declining hair, which means overall the business operationally is hair. And that wasn't a good investment. So what I learned from that is that I should go into companies that don't have this declining aspect of their business. They don't have this problem they're dealing with. Netflix was similar to Disney on the upside, where they're building a streaming service, but they had no declining cable TV business. So Netflix wasn't, they didn't have this cumbersome problem to figure out. So once I realized my mistake, I thought I'm going to go with the market leader, the one that already has a dominant market share, the one that has no declining cable TV business, the one that has all this organic growth trends. And that's when I quadrupled down on Netflix. So that was one thing. I lost maybe $5,000 or $6,000 on Disney. I probably could have earned it back if I bought back in at the lows. But I when I move on from a company, I just want to be done with it. Another one was investing in Alibaba. It wasn't a big investment. I put 10,000 total into it, I believe, and I lost some amount of money. I can't remember, like $3,000 or $4,000. And to me, that was a lesson that it doesn't, like, Alibaba seems perfect on paper. At least it did then. It was growing fast. The valuation was super low. They're in all these great businesses and secular trends with cloud and retail, just like Amazon. And it didn't seem to matter if nobody has trust in the entire fundamentals of the company. Like, people don't even trust the balance sheet or the numbers they're reporting. People don't trust the government from them. So to me, it was just a huge headache, a company that I didn't want to deal with. I'd rather just invest in a European company, one like ASML or Booking, or a US company, where at least people like trust what's going on. There's a level of trust between what's going on in the government. So that's why I don't make any Chinese investments. I don't invest in Chinese companies that are owned and operated out of China. I'll invest in companies that have some exposure there, but I'm not going to buy companies that are owned and operated there. In terms of the semiconductor question, ASML to me seems like it has the strongest monopoly, the strongest moat between all of these businesses. ASML's growth has been organic over a long period of time. NVIDIA's happened all in 1 year. I like a company that has a long track record of organic growth than one that had a huge one-time explosion growth. TSM and Broadcom, I think all of them are great, but I don't think they're as monopolistic as ASML is. Joseph, you've mentioned that Applied Materials and how it may be even better than ASML. Why did you decide on ASML versus Applied Materials? Can you give us a little breakdown of each company, the pros and cons of owning one versus the other? Thanks. Yeah, there's two different ways to look at this. Applied Materials has a pivotal role in multiple parts of the process, but not as dominant in any one part. So they face more competition. ASML only plays really one part, which is lithography, like printing patterns. But they're it. They're the only game in town when it comes to that. No one else really comes close right now. So you're just making a decision there. Do you want the one that's dominant in one part or the one that plays a pivotal but less dominant role in multiple parts? And there's pros and cons to each. I went with the one that I think is more monopolistic. I like that idea of owning a company that plays a super important part of just a small niche aspect in this big supply chain. What are your thoughts on Brookfield Corporation, its valuation right now versus ASML and Google? I've looked at this one a number of times. I like investing more based on the product and the market dynamics and the company itself and the products and what they're selling and to who they're selling and their growth cycle, more than I invest based on the leadership and whether or not I think the leader's like a brilliant leader like Bruce Flatt. So I think a lot of the Brookfield Corporation is based on the leadership and what they can make of the company. It's kind of like just handing your money over to someone else to manage. And I think it's a great company. It's interesting to me that Bill Ackman went into this one. Bill Ackman is often attracted to these type of situations where there's a brilliant leader. But I like, ASML's leadership and Google's is important. But to me, it's their product dynamics, the market share they have. That's way more important. Like ASML and Google have many people that could successfully lead those companies because the previous leader, they're set up in such a good situation. Hi, Joseph. Longtime subscriber here. Love the content. Keep up the great work. I was wondering if you've looked at MGM Resorts, especially since you've invested in Vici Properties. MGM appears to have promising growth prospects with their iGaming, BetMGM, New York expansion, and investment into Osaka. Ooh, they're expanding into Japan. Their casinos and resorts provide unique experiences that are difficult to replicate, and they hold a large amount of the Vegas Strip property, which is finite. Between their iGaming, Asia market presence, regional casinos, and Vegas properties, they have diversity than any other company in the industry. They're buying back shares. They've reduced the share count by 40%. I'm probably not going to be buying this one because it is true that they're expanding, but all of this is purchased expansion, right? So I like that MasterCard grows just by more people doing transactions. They don't have to pay for that growth. With MGM expanding, they do have to pay for these new properties. They have to go through all the red tape. It's a very expensive process. So even though they're expanding, the profitability, in my opinion, it's harder for them to have pricing power. And I think if you ran MGM through all the filters I look for, the investment philosophy PDF of all the attractive and unattractive traits, it just doesn't fit with enough of the attractive ones. It has too many things like inorganic growth, lack of pricing power, growth through acquisitions, that I don't think it fits as one of the top companies. Now, I don't think it's a bad bet. You might be able to make a lot of money on it. But also historically with these type of companies, I look 10, 15 years out, and I think it's difficult for them to be compounding machines that are going to grow organically for long periods of time. Joseph, I recently watched How I Research Companies and gained a lot of insights on qualitative analysis. It's been a few years since you released that video. Do you plan on releasing a video update? If and how this process has changed in the years since the video? Do you still focus heavily on the fundamentals and qualitative? Have you started to include technical or quantitative as well? Are there any game changers you've discovered that improved your fundamental analysis and qualitative analysis? I don't think there's enough to redo the entire series. Fundamentally, it is what I look for. The specifics of the analysis are always changing. I use the new tools in Qualtrim. I like looking at the AI generated weaknesses and strengths when I'm looking over new companies and stuff like that. There's a couple new charts that I look at. So the process has changed a little bit. But no, I think basically the investment philosophy and the way that I do analysis has stayed the same for the past couple years. So it's not enough that I'd at least want to go and redo all the videos yet. How do you feel about the news that more than 50% of Amazon top sellers are based in China? It's not shocking to me. Look how much China exports. Amazon's the biggest online retailer, so it makes sense it would kind of match the dynamics of where we're getting our stuff from. In the US, we get our stuff from China. So, it's just Amazon is just matching where stuff comes from. A lot of it comes from China. It makes sense that a lot of sellers are from China. Do you still believe SCHG will outperform SPY in the next decade? I do. If I was to make a bet, I believe it will. Valuations will be a headwind, but many of the top companies SCHG is leaned into, they're so good. They're so good companies. They grow their earnings per share and their free cash flow per share, and they have excellent balance sheets, and they do buybacks and pay dividends. I mean, they're very difficult to beat. They have long secular growth trends, and SCHG holds a lot of great companies. I think it's going to do really well. No guarantees though. Hi Joseph, I'd love to give an update on your dividend inflows over the last couple of years. I just watched an old video from 2023. Yeah, I could do that. Maybe I'll go over and give one. I think I'm going to get $8,000 in dividends this year just from the passive income portfolio. How do you calculate intrinsic value of a stock? Could you provide a concrete example of how to calculate it? Would you please be able to show both your portfolio's passive and story of each stock weighting? Maybe in a future video I'll do the stock weighting, but I can go over how to calculate the intrinsic value of a stock. That's an interesting one. Let me use an example here. Let's go to Starbucks pulled up here. Let's go to S&P Global. This is one. It's a large holding of mine, so I'm more familiar with it, and I can go over my thoughts on calculating the intrinsic value of a stock. So first of all, what is the intrinsic value of a stock? It's what a company is actually worth. So price is what you pay, value is what you get. The intrinsic value is the value. That's what you're buying. Doesn't matter what price you're paying for it. If you pay $1 million for a Honda Civic from 2015, it doesn't make it worth $1 million. It just means you overpaid and you got the Honda Civic, right? So price is what you pay, value is what you get. Intrinsic value is the value of the thing that you're actually getting. Now, in my opinion, there's lots of different ways to come to the conclusion of what a company's actually worth intrinsically. In my opinion, a company's intrinsic value is determined by three different variables. One of them is growth and how much the company is going to grow and how fast it's going to grow over its entire lifetime. One of them is predictability, which is basically not only is a company going to grow, but how sure am I of that growth? How confident am I? Am I 100% confident? Is there no way it won't grow that fast? Am I 90%, 50%, 20% confident? The predictability of the growth is the second variable. And then the third one is the starting yield of the company. So basically, what is the current multiple right now? Based on those three variables, you can come to the intrinsic value of any company. Again, the growth, the predictability, and the starting yield is the only three variables that define the intrinsic value of a company. So if I look at a company like S&P Global, and I come to the conclusion that it's going to grow moderately fast, around 12% per year, let's say, for the next 5 years and going out from there, but we'll do analysis to 5 years. If I think it's going to grow around 12%, that's, and then I think the margins are going to grow over time. I think the free cash flow is going to grow over time. That's fast growth. And I think the company's highly predictable. Now, this is where we break down things. So if a company, you have two different extremes, and we want to find, not the soup that's too hot, not the soup that's too cold. We want it perfect, right in the middle, right? Where it's just right. We don't want companies that are growing super fast but are unpredictable. Those are like biopharmaceutical companies. They have explosive one-time growth, and we don't want to just say, oh, this company is going to grow like crazy, because it's unpredictable growth. We don't really know how fast that company is going to grow for the next 20 years. So fast growth and being unpredictable, we don't want that. We also don't want super predictable but slow growth. That's companies like Procter & Gamble, Hershey's Corporation, big consumer conglomerate defensive companies. They just grow too slow. Their intrinsic value is brought down because even though they're highly predictable and they're saturated and they have huge market dominance, their top line growth rate and organic growth rate is super slow. So their intrinsic value is lower, even though they're predictable. So we don't want fast growing, unpredictable. We don't want highly predictable and slow growing. We want to find that right in the middle where you get a good blend of above market growth, very predictable, and a decent starting yield. And those are the companies that I try to throw into my portfolio, because when you find those three variables that align perfectly, that's where you have a high percent chance of outperforming the S&P 500. So when we look at S&P Global, the company has a very long track record of growing above the market organically, rates of 12 to 15%. So I estimate this company has moderately fast growth. Not super fast, but moderately fast, faster than the rest of the S&P 500. And then the company has a highly profitable business model where it's not only growing, but it's growing profitably with scalability. In terms of predictability, I rate this company as highly predictable because it's diversified into a lot of different segments where it has dominance, where it's a gatekeeper, or it's kind of a monopoly. So it has moderately fast growth and it's highly predictable. And then I look at the starting yield and I say it's a starting yield that's right there in line with the S&P 500. The S&P 500's average weighted yield is around 3.5%. S&P Global's is 3.3%. So we have a company that's growing faster than the market, that's more predictable than the average company in the market, and has a yield, a valuation that's around the same as the market. I think the company, based on those data pieces alone, is likely to outperform the market. That's very simple logic. Now, if we actually look at this closer, we can run different scenarios on this through the scenarios tool. I need to rename this. I'm just going to rename it scenarios and then in parentheses DCF for discounted cash flow. A lot of people don't realize that this is a DCF calculator. The way that what a discounted cash flow analysis is projecting out the future financials of a company, making those projections, building the financials of what you believe they are, and then applying an appropriate discount to those cash flows based on the growth rate and the risk of the company. So when we do this, let's switch over to S&P Global. And I've done this for basically every company, most of them that I own. all of them that I've owned and many of them that I don't own currently. But if we go to S&P Global, we have the scenario here. Let's take a look at it. And this is actually from 2023. So we get to see how things turned out. Now, again, we want to build out our assumptions here. I did this with 11% growth, 48% EBITDA margins, 0.5% of CapEx to revenue. This business has like no CapEx. And then out of the predictability of the company, I put it as highly predictable. So we have the analysis there. This is what I did in 2023. It builds out the cash flows of the company. And since we did this a couple years ago, I can actually see how things are going. In 2024, based on this analysis I did, the company was expected to generate $4.86 billion in free cash flow. That number right here. Now, if we look at what they actually did, we can look at it here. And they did 5.14 over the trailing 12 months, meaning that I'm actually conservative. My estimates of S&P Global actually came in under what they did. And it's pretty accurate, 5.8, or what was the number here? It was 5.1, and I estimated 4.86. So I'm off by a couple $100 million. So pretty accurate estimate. If I was to guess, it probably is going to grow closer to a 12% rate. So I'm probably under the revenue growth a little bit. But either way, this is discounted cash flows. None of this is precise. This is to give you a ballpark to see if you're way off or if you're close. None of this should be precision. Don't take any of these numbers with precision because the future is unknown. It's not going to come in exactly like you lay it out on paper. But regardless, we get an idea of what to expect based on these assumptions. In 2028, based on these assumptions, S&P Global will be putting out $8.47 billion in free cash flow. Based on that, we can also make some assumptions on the current yield of the company, of what this company will return in compound annual returns. Now, this is where things get a little bit tricky. People have a hard time wrapping their head around this. So I'm going to just explain this super clearly. The lower the yield, the lower the free cash flow yield of a company, the more expensive it is. So if you buy a piece of real estate that's at a cap rate of 2%, meaning a 2% yield, that piece of real estate is twice as expensive based on the cash flows as a piece of real estate that has a 4% cap rate or 4 cap. Because you're getting out of basically the way to look at this is if you invest $100 and you get 2 back a year, that's a 2% yield, 2% free cash flow yield. If you invest $100 and you get $4 back to you every year, that's a 4% free cash flow yield. So when you're getting more back, that means that the company's priced at a lower multiple. Now, let's go ahead and just take a look at this. Based on these assumptions, if S&P Global, and I believe it could trade at a 3% free cash flow yield in 5 years, that would put it at a 12% annualized return over the next 5 years. I think that's a decent estimate. If it trades at a 3% yield, it'll give me a 12% annualized return. That'll probably be market beating. The market expectations are very low. The S&P 500 is supposed to have a very low return. So I find a 12% return rather attractive. Now, if investors price the yield even lower, meaning they're paying more for the company, again, as yields go lower and lower, that means investors are paying more and more for the same cash flows. So companies like NVIDIA, they have super fast growth, and investors are pricing that in with a low free cash flow yield. So if we go to NVIDIA here, let me illustrate this. NVIDIA has a super low yield, 1.7% right now, and that's because investors have priced in a lot of growth. With Palantir, this is like the most dramatic example we can have in the market. A 0.5% yield. That means the company's super expensive. Investors are pricing in the skies in terms of growth. So when we look at this, just keep that in mind. We look at this and the lower the yield, the more investors are pricing in. That means the companies become more expensive. The higher the yield, that means that investors are selling out of the companies. They're pulling their money out, meaning the free cash flow yield is going up. So that means that the company is becoming cheaper. Now, if you buy a company and everybody sells out of it and the yield goes up, your returns are going to go down. You don't want to buy and have everyone sell out of the company, the yield go up and the multiple go down. that would mean that you have a bad return. So in the case that the yield is actually going up and the multiple's going down, the company's becoming cheaper, that's not a great thing if I'm investing today. So like if the yield is 3.5% in 2028, then my return would be 8.74%. It's still positive, but not great. If the yield goes up to 4%, my return goes down. If it goes all the way to 7%, something went wrong. Imagine if S&P Global traded at a 7% free cash flow yield. Like something went really wrong, because that means that people don't want to own this company. In that case, I actually get a negative return of 5%. So again, I think the area it's going to trade is right around here, 2.5% to 3.5% yield. In each of those scenarios, I get a nice, healthy, positive return. And that's in a market where it's tough to find tremendous deals right now. So I like these returns. Anywhere from 8.7, about 9% annualized return to 16%, depending on how this company is valued by the market at the end of 2028 will determine my CAGR. And so in terms of intrinsic value, I don't think about it in terms of price points. Like I'm not saying the intrinsic value is X amount of dollars. I think about it in terms of rate of return. Meaning, if I expect a company from today to give me a 12% or higher return, I think it's undervalued. Because I'm assuming that the market's going to return around 8% or 9% on average per year. So if a company's going to return more than the market, it's undervalued. Whereas if a company's going to return 7% or lower, I think it's overvalued. And then if a company's going to return around 8 to 9%, I think it's around fair value. So that's how I look at intrinsic value. Again, if my future expected returns around 12 to 13% or higher, undervalued. If my future expected returns are under 7%, overvalued. If my future expected returns are kind of in line with the S&P 500, around 8 to 9%, I think that's around fair value. It's just going to trade in line with the market. So when I look at my companies, I want every one of them to have future expected returns that are above the market. When I'm buying companies, I just want them to be able to generate excess returns. And I redo that analysis at different time points. I try to do it continually with different companies and make sure every holding I have has a future expected return higher than the S&P 500. Now, let's see if we have any more. I think that's quite the answer there. I guess we went on for a little bit, maybe 10 minutes on that one. Yeah, let's take a look, see if we have any more interesting ones. I think I'm going to call it there. I'll get this exclusive uploaded. If you have more questions, just put them back in the chat here and I'll try to go through them. But I think we went through a lot there. Let's go ahead and wrap it up there and I'll see you guys on the Discord.